Good morning, everybody, and welcome to the Mortgage Coach Tuesday interview. Every Tuesday, we are interviewing someone special, someone valuable to mortgage professionals. And today we have Mr. Dan Rawitch. What's up, Dan?
Hey, buddy, how are you?
I'm good, man. It's good to have you here. And if you are a new loan officer on this call, I'm telling you right now, guys, this is someone that you want to listen to his morning update, someone that you want to learn from. I actually, Dan, I think you saw I released yesterday the Mortgage Coach new loan officer playbook, and you were a very important part of that. 4 steps to going from I don't know the mortgage business, I don't even know might not even know how to spell mortgage, might not know that it has a T in it, to you're an expert. You were an important part of that, brother.
Thank you. It means a lot.
Yeah.
I saw that, by the way. Wow, I cannot believe that book.
Yeah, no,
Powerful.
I think well, you asked me, dude, you put a lot of time in that. I mean, I've interviewed a lot of people and I just kind of codified takeaways from some great leaders that have onboarded hundreds of loan officers and done it successfully and done it rapidly. It really surprised me. There's a lot of new loan officers coming into the business, and by the end of their first year, they're like trending 100 loans a year. Like I don't think it's ever been easier to get into this business and go from 0 to hero. I don't know.
Interesting.
Yeah. So as our co-host, we have Todd Bookspan. Todd, thanks for joining us, brother.
Hey, always great to be here. Anytime I can sit here and learn from Dan live is a great opportunity for me.
Stop it.
Well, I know it's going to be well attended. Everyone wants to know, like, hey, what are interest rates going to do in 2022? And more importantly, what are they going to do over the next 30 days, 60 days? So we'll get to that in just a sec, guys. I did want to do a reminder to everyone. We are currently focusing for the month of August on the TCA a day challenge and the CMA a day challenge. At 11 o'clock today, we'll actually have Jeremy Forcier doing a live accountability coaching session with about a half a dozen loan officers that we'll kick that off, where Jeremy will be like, hey, what are your metrics? How many leads? How many loans? How many price exceptions? And then we're going to talk about both how can you do better TCAs, and then we're going to transition that to the conversations with realtors, getting realtors to do CMAs. So one side of this report is TCA a day, and the other side of this is CMA a day. So guys, Jeremy bought 200 of these, 50 for all the loan officers that he manages, and 150 so that he can have 150 conversations with realtors where he's saying, hey guys, slowing down a little bit. Best way to get listings is do a CMA a day. And then Jeremy, as a mortgage coach, is saying, hey, I will partner with that CMA with a move up analysis, where he says, like, this is exactly what moving up looks like for that family. And guys, there's a lot of families that have a lot of equity in their home, and they can move up, get that extra bedroom, get that better school district, and then take some of that equity, buy down the mortgage, and actually have a lower payment. So bigger home, lower payment, it's all over the place. It just requires a good realtor and a mortgage coach to do that. So guys, make sure you're following up on that. Todd, anything else you want to say on that before we bring Dan on stage?
I don't want to steal her thunder before the 11 o'clock, but Tammy Kranich, we had a mastermind yesterday. We had Jimmy Burgess on, who's the realtor who did $11 million worth of listings as a result of doing CMAs over 90 days. And then since then has done over 5 million in sales a year later, just off of those same original CMAs, because he's actually moved out of production into a leadership position. And I don't want to spoil her big win, but she's already got, after 1 week, a few realtors who've already gotten a listing, and one of them actually got her a refinance. So how cool is that? She's adding value to her real estate agents by getting to be involved in the challenge, and she got a refinance handed off to her, hand delivered by one of her realtors. So I can't wait to hear more about that story.
Yeah, I can't either. Guys, I'm going to put a link down below. I wrote a playbook on that last week. It's about a 3-minute read. It's in my LinkedIn profile. And we took 7 minutes from a call a couple of weeks ago with Jeremy, and we have his CMA script. So you want to hear exactly what Jeremy is saying to real estate agents? Listen to this 7-minute quick hit. It's in our YouTube channel, and we'll put a link down below. And then remember, guys, we've got Win by Noon came up with these bitchin' wall posters. They're only $5 a pop. Be sure to buy some of those so that one, you can, as a loan officer, put it on your wall, remind yourself to do that TCA a day. And then remember, if you flip it over, there's a realtor version to do the CMA. So check it out, guys. With that said, Dan Rawitch, for anybody that is new to the business, if you don't mind just telling a little bit about yourself, and then let's get into the update.
Sure. So I got in the mortgage business in 1978. I was a freshman in college, and my dream right from day one, I learned about secondary marketing, and I was fascinated. And I said, someday I want to work on Wall Street and be one of those guys. And so I graduated, and I did. And so I was a bond trader for a number of years back in the 80s during the Wolf of Wall Street days. And that whole scene in New York was a little bit much for me. Literally, if you see that movie, a lot of that's true. There were guys I was working with snorting coke in their limos on the way to work in their 20s. So I begged almost from day one to get moved back to San Francisco to work in the San Francisco office. And at that point, I became what was called an asset liability manager. So I helped major financial institutions balance their assets and liabilities. And that involved hedging and all that cool stuff. And then I helped them launch their mortgage conduit. Then I started a credit boarding company, sold that to TransUnion. Then I started RPM Mortgage, sold that to Finet, became CEO of Finet. And it kind of just goes on and on. I mean, when you're old, like me, and you've been doing this for 40 years, at some point, you've done a lot, and you've met a lot of people, and it's been an amazing. If you're new, congratulations. I mean, this is a life-changing industry. Very few of us ever grow up and say we want to be in the mortgage business. It usually just happened to most of us, and it's a blessing. It really is. If you do the right things, you can make more money than, brain surgeons, and add as much value in some ways. I know that sounds really fallacious, but it's true.
So, and I want to put it another way, guys. So if you're new to this business, you've got a guy who has been a loan officer, has built large companies, been a CEO, been a regional leader, worked on Wall Street, and he's been studying the relationship with what's happening in the economy, how does that impact rates, studying it in the most detailed way, and he nets that out every morning for you. So if you have not downloaded the Mortgage Coach Rate Watch app, download it today. And Dan is putting a video in there every single day, not to mention that it's available on social media. Then he's got a membership program called marketmentorship.com, where he really goes deep. Like if you want to get like your bachelor's degree in mortgages and interest rates, Rate Watch, you'll get it. If you want to get your master's degree or your doctorate degree, then it's marketmentorship.com. And I am not exaggerating when the level of content, the constant education, the mentorship would be like, if they taught it at Harvard, that's what you're getting. You're getting a Harvard, again, I might, Harvard probably wouldn't like it. I'd probably get a cease and desist from their attorneys. But it would be higher education, and you'd be among the smartest mortgage professionals on planet Earth if you just watch those videos every day and you follow Dan. So with that said, Dan, what do we have in store? What do rates look like they're going to do over the next 30 days, 60 days? And what does next year look like for us?
Yeah. So just share my screen. Yep.
Yeah, go for it.
Okay.
And we see your slides.
All right, cool. So yeah, there's the URL just in case you want to check us out. I'll talk more about it at the end because I think you'll be interested. And Dave, I appreciate all the kind words you said. And it's interesting. Just before this call, I did my my market update, which I do every morning for our members, and every day at the close. And I said it'd be great to have you guys, but you don't need to. You know everything I'm going to say. You saw it Sunday night in the video. You heard about it yesterday. You knew which way rates were going to go for the last few days. So I think it does give our members an edge. And from what I'm told, it helps give them confidence when they're out talking about finances to borrowers. You should know a little bit about the financial markets. All right, with that, let's go. I'm going to do a quick spoiler alert. Look, I think rates are going to get a little bit worse before they get better. And I'm a little concerned about the CPI number, which is Consumer Price Index, on tomorrow. And if that number comes in hot, I think we could see rates get worse. But I'm going to show you a chart. I don't see it as like, oh my goodness, kind of situation. I see this as a normal, healthy pullback. The concern that I have, and I'll share some slides, is there are a lot of people selling bonds short right now, meaning a lot of big traders are betting against the bond market. And it's coming from a lot of this tapered talk that the Fed keeps floating. What the Fed will do is they'll float a word, they'll float a concept out there, and they'll do it as many times as they can without formally making an announcement to test the market and prepare the market. And that's why you hear in the stock market, you hear buy the rumor, sell the news. So if you heard a rumor that Apple was going to, report record iPhone sales, people start buying the stock when they hear that rumor. And then when the news comes out, they dump it. So it's kind of the same thing. When the Fed talks about doing something, people start selling or buying. And then when it's actually done, it becomes like, so what? So with that said, let's just kind of jump in. So you can see that Treasury is short. They're short now as they were during the 2017-2018 cycle. And this more or less came out of nowhere, and it more or less came after the last Fed meeting where he talked about tapering just a little bit too much. And it's just another chart shown another way. And this is from JP Morgan, their Treasury client survey. It's actually the Treasury client saying, yeah. So these were where almost no shorts, and this is as the shorts continue to climb. And we're not seeing them covered. So what that means is when I sell something short, let's talk about the famous GameStop or AMC. AMC today it's another big deal because they announced their earnings. If I think a stock is too high, or I think there's bad news coming, and I want to short it, what I'm doing is I'm selling something I don't own. And the way that works is I call the broker. I don't really call them. That's old school. I go online and say, I want to sell 100 shares of GameStop at $30. Pretend it's selling at $30, or AMC at $30. And so the broker goes out and borrows shares from me, and he gives them to me, and I sell them. So I'm selling these loan shares at $30. At some point, I got to go back and buy those shares back so I can give them back to the broker. I don't have to give them back at 30. I just have to give them back the 100 shares. So if the stock goes to 10, I go into the market, I buy the shares that were given to me at 30, and I already sold them. The profit's in my pocket. Now I got to go back, buy them back at $10 and give the shares back. Well, what happens when the shares go the other way? If the shares go up to 40, 50, 60, 70, 80, well, as the stock's going up, I'm rushing into the market. I'm trying to buy those shares to cover that short. But everyone else is buying the stock not only to cover the short, but because it's going up, and everybody likes to buy momentum stocks, and you get what's called a short squeeze. So we're not seeing any shorts being covered, even as rates were coming down recently. I would have thought this move would have been a little bit more explosive with the shorts beginning to cover. But people that were holding Treasury short have continued to be convicted that rates were going to go up. Not a majority of them, but enough of them. And then this is something you've heard me talk about if you followed me for any time at all, and that's the yield curve. The yield curve is if you take, let's say, the 1-year Treasury bill, and then you take, let's say, the 30-year bond, and historically, a 5 year is going to be a higher rate than a 1 year, and a 10 year is going to be higher than a 5, and a 30 is going to be higher than 10, and you get this sloping yield curve. This slope in the yield curve tells economists and forecasters everything they need to know about what's coming. It doesn't lie for the most part. And because when the yield curve gets really steep, it's like long-term rates get much more expensive, or the yields go much higher than short-term rates. That's the market's way of saying, I foresee a lot of growth, and I foresee some inflation fears. And if I'm going to invest my money longer term, you better pay me through the nose. And so the yield curve tightens as people believe that inflation's coming, or that the economy is going to explode. On the other hand, you've heard the term inverted yield curve. All of a sudden, short-term rates are higher than long-term rates. Well, that's because the market's seeing no growth and they're fearing deflation. And because if you think about it, I don't want to go out long-term because let's say a 2% Treasury note might be really worth zero if there's deflation. I want to lock in these higher rates right now. And so shorter term rates become worth more than longer term rates. And an inverted yield curve has predicted the last 7 recessions in advance. So what's been happening here is quite interesting. And that is the spread between the 2 and the 10-year just keeps getting narrower, narrower, narrower. So basically beginning in about March, the spreads were tightening, the yield curve was flattening. And this was the market's way of saying, guys, I don't see inflation and I don't see a roaring economy. And this spread, it's never lied to me anyway. Now, in the last few days, it has ticked up. I will say that. But look at where it's come. We have the most short treasuries in a year. You can see that right here. And again, if people are shorting the treasury, they're betting against it. This is a longer term look at what's been happening with yield. Now, this is a yield chart. And I'll pat myself on the back real fast. I did a talk for National Association of Mortgage Professionals. And the talk was March 7th. And they pointed it out. I promised that rates were going to drop, that things were going to peak. I showed them kind of the opposite of this graph. It was going back from the 80s, and it was showing this line that went all the way down. And I said, every time we've touched this line, rates have fallen like a rock. And I gave other reasons, very much the same stuff I'm going to share with you now, why I thought that rates had topped. And from that day forward, they just fell and fell and fell. So that was kind of fun. I don't have that same news for you today. I'm still extremely bullish, but short term, I'm a little bit nervous. But you can see here, this is a dangerous spot. This is a downward channel, and we are butting up against the end here. And as of today, we've broken through that. And when you break a long-term steep channel, it usually does kind of break to the other side. On the other hand, now I would tell you right now, there's some conflicting data. And so our job is to look at these data points and sort of synthesize the data and decide what makes the most sense. It would be great if every single data point agreed with every other data point every day. That would be so cool. It doesn't happen that way. But this is Goldman Sachs, and they're putting together what they believe the odds of high inflation is, and what's happening. This is the change. So you can see the amount of people that thought inflation was going to be 2.5 to 3 or 3 and above. That number has fallen drastically. So the market is now speaking, oh, maybe inflation is not a concern. And you guys have heard me say this now for a few months. This whole thing has been overstated. And these are the amount of people that think inflation is going to be 1.5 to 2 or 2 to 2.5. So the expectations of the market's kind of moving in the direction that we want it to. Flip side of that, and I think this is a really short-term problem, but it's indicative of a bigger issue. This is the cost of shipping stuff. And if you've been through Long Beach or Los Angeles or any major shipping port, and really in the world, shipping containers are backed up forever. And they're waiting at seas for days and days trying to get in. The cost of shipping has never been higher. And you heard me use this probably last time. So the way I look at the whole economy right now is during the pandemic, we didn't eat. Now, it's a metaphor for buying stuff, living our lives. And we got very hungry. We got hungry to live. We got hungry to shop. And as things began opening, we went to the buffet and we just started stuffing our faces. And I think most of us are getting pretty full. People are backing away from the table. But meanwhile, you have these chefs in the back of the kitchen, and they're just, I picture like not PF Chang's, but Panda Express. They're going, more honey chicken, and they're yelling back to the cook. Well, no one's really telling the cook anything, and he's just throwing chicken in the wok over and over and over and over and over, and he's not even looking at the line. And what he doesn't realize is there's no longer a line out the door, but he keeps throwing chicken in the wok, and all of a sudden they're going to have these mounds of chicken sitting, in the food line, getting cold and going bad. This is exactly what's happening right now. People are moving away from the table. They're not as hungry, and the cooks keep cooking, and the shippers keep shipping, and the producers keep producing, and you're going to end up with bad inventory, and that is recessionary, and that certainly is a huge drag on the economy. I couldn't feel more strongly about that. But until this number starts turning down, I won't be completely ready to tell you inflation's peaked. I do think it's very close. If it hasn't peaked already, it's within 30 to 60 days of peaking. And by the way, this is the first little tiny, gotta be squint, but you can see this line is beginning to turn just a little bit. And the Fed's not helping, right? The Fed, we call this the Fed BS. This is how much money the Fed keeps throwing into the system. This was during the pandemic. Look what the Fed did. Unbelievable. And this index here, the MOVE index, most of you probably heard about VIX. VIX is the fear index. VIX is what I invest in when I see problems in coming in the stock market. Right now, I have a decent sized position in the VIX. And we use this for two reasons. We either just do it as a hedge. Maybe I have a bunch of stocks right now that I love, and I don't really want to sell them. So I just buy a bunch of VIX. And if the stocks do come down, the VIX goes way up, and I make more money on my VIX than I do losing on my stocks. Or if I'm really bearish, which I'm getting there, I start selling my stock and buying the VIX like crazy. Well, the MOVE index is the VIX for bonds, and we really don't want to see this elevate. And the problem is, as the Fed keeps putting money in, he's elevating this index. And it's the one problem he can't solve. Well, he can't solve a lot of problems, but it's the most obvious. And this typically will precede, rate movement. Short term, don't worry. Here's a sign that maybe we've peaked. If you followed what's been happening with auto sales, specifically used cars. Oh my God, I have a Ford F-350 pickup truck. It's a 2017. I don't remember exactly what I paid. They're not cheap, but it's worth, I would have thought it was worth maybe half of what I paid for it. You know, it's been what, 4 years? It's worth $10,000 more than I paid for it 4 years ago. That's happening to used cars all over the country. And all of a sudden, boom, we're starting to see consumers are getting full. I am not that hungry, but the manufacturers of autos, they're not going to slow down for a while. They're gonna over manufacture. And I know this because here's what pendulums do. They go this way and this way and this. They don't go this way and that way. They might do that, but whatever they go here, they go that much the other way. Yes, I'm saying, Dave. No, just looking. Okay. So this is the Citibank surprise index, and you can see after the pandemic, virtually every economic surprise we got was a good one. And since then, every economic surprise we get is a bad one. So when people talk to me about this roaring economy, I chuckle to myself, like, what are you looking at? How do you keep me say that? And you can see it's not just in the US, it's the G10 countries, it's everywhere. Everyone is beginning to see negative surprises. I will say, full disclosure, last week, this index did turn up just a little bit. But that happens. The trend is still very strongly down. And the headline here is, it isn't hard to understand the bond rally when you look at this chart. This chart is the reason I remain bullish on bonds. This is a chart showing the 2-year, 10-year spread, which we already talked about. And it's showing you where the yield curves appear to have peaked. And this tells you again that it's likely that inflation and the economy has peaked. Consumer sentiment dropping, and that's because of COVID. And I think that COVID is, I don't even like talking about COVID. Most of you probably feel the same way. Like, I am annoyed when I see people wearing masks. I get it, but I'm annoyed. And now this Delta variant, wow, I'm thinking about it. I don't like thinking about it. And in fact, I'm supposed to have a booth at the AIM convention in Vegas next month. And they're like after me, Bennett, if you're on this call, sorry, to send the contract in. And I told them I would. And every time I read anything, this COVID thing is getting ridiculous. And so I'm thinking, I'm not afraid to get sick, but I don't know that I want to be with 3,000 people while this Delta variant is out of control and potentially, I realize it's a political issue. I'm not trying to do that. Please don't argue with me. I'm just sharing my feelings. But the Delta variant apparently is not really care much whether you're vaccinated or not. That's what the stats are saying. And it's gaining traction. So all of a sudden I'm thinking, I'm going to pay all this money and the conference is going to either cancel or instead of 3,000 people going, there's going to be 1,000, and I'm not going to get what I paid for. So if I'm thinking that, I got to believe a lot of people are, and this is going to continue to just drag down the economy. Meanwhile, we have this taper talk. And by the way, did anybody know that the Fed bought $160 billion in treasuries and mortgage backs in June when they were supposed to only buy 120? I found that very curious. Clearly, they spent 20 billion less than they should have here, but they spent 40 billion more here. They spent more here. They spent more here. But you can see this is JP Morgan thinking the tapering starts by the second quarter of 2022. I think when we reach that point in time, the Fed's going to be talking about more stimulus, not less. That's my opinion. I see things slowing. So I talk a lot about all this money that's flooding into the system. And there's this silly belief that stimulus is inflationary. It's not. People talk about printing money and throwing all this printed money. The Fed doesn't print money. The Fed prints debt. And then the Fed goes out and sells that debt and takes that cash. That's how money's created. It's created through the formation of debt. And they have to pay that debt back, go figure. And the way that they pay that debt back normally is by printing more debt, because we don't make enough money really we do, but barely make enough money to pay our debt. And the problem is, as this is happening, the more money that goes into the system, the more stagnant it becomes. It doesn't go anywhere. This is called velocity of money. And when money is stagnant, the economy is also stagnant. And you can see what happened just before the recession of 07, 08. The velocity just took a dive. Well, the same thing happened beginning in 19. It's gotten a little bit better recently. It's certainly something to watch. If you saw suddenly the velocity of money just skyrocket, you'd have to be thinking, well, maybe there could be some inflation, but I don't see it happening. I just don't. The more money the Fed dumps in, the banks go, oh, thank you very much. And they have so much cash, they just throw it in the overnight repo funds. Basically they lend it to other institutions, these overnight rates. So they get paid these great yields. Their cost of money is virtually zero. They get paid a return and they take no risks. And the last thing they want to do is lend it out to people that might not pay it back. Well, if the banks aren't lending money, we're not going to grow. This is a more random, but it's part of my overall macro concern. Things swim around in my head. Did you know that 5 companies make up the S&P 500 total value? So 5 companies are worth as much as 495 other companies. So when you hear about the stock market going up and up and up and record highs, it's 5 companies, guys. So this is a concern, because if this blows, or 1 or 2 of these blow, you're going to see the net worth of consumers really damaged badly. So this is, I hate reading slides, but I just don't know how visible this is. And this kind of makes my point. Fed members have become more vocal about the need to taper the current level of quantitative easing. This is Clarita's, Fed Clarita, his comment. You had Kaplan's comment. I thought there was one more on here. Kaplan says, as we make substantial further progress, which I think will happen sooner than people expect, I think we'd be better off from a risk management beginning to adjust these purchases of treasuries. And this is what Michael Lipowitz said: the Fed drops trial balloons to gauge the market's reaction. If the markets remain stable, the Fed can adjust either the verbal language or actually take the action. It's easy to take back a comment. It's very difficult to undo something that you've done. This is why I think that they can't taper. This is actually the employment. This is how many jobs we lost up here. And this is how much better it's gotten from here to here. This is where it was. And I would just tell you that getting back to even isn't the same as growing. Talking about jobs, I could say that about every single factor of the economy. All we're trying to do is get back to even, and somehow people have changed that into things are growing and things are amazing. And when that all levels out, you'll find that there's no inflation and that there's a need for, I would say, much lower rates than we have today. This one scares me. If we strip out the retiring baby boomers, old guys like me, it's hard to suggest we're in a roaring economy. 50% of the working age population are employed full time. This is lower than any previous employment peak in history. That speaks to productivity, which, by the way, productivity was released this morning. It's down again. If we're not productive, we can't grow. This is a little bit of a scary slide. And what I wanted to point out is there's a couple things, because we keep talking about tapering. But what I want you to realize is a lot of times when the Fed first tapers, things get better. Rates go down. And then, of course, they go up. So now this is, the S&P on one side and this just smoothed out S&P line. So as they talk about hiking rates, the stock market gets hit. Usually the bond market does better, at least on the short term. But this is the takeaway of the day. Since the financial crisis, total government intervention surpassed 43 trillion to keep the economy afloat. The cumulative growth of the economy is only 3.5 trillion. For every dollar we spent to keep Humpty together again, for every $12 we've spent to keep Humpty together again, we've gotten $1 value. The Fed now has to spend $12 to get $1 of growth. This has doubled from a year ago, which probably doubled from the year before. This is a very slippery slope we're on. And the more you do, the more you have to do. The lower rates have to be, because the government has to pay this debt. Diminishing rate of return on QE programs become more evident. While increasing QE does not increase economic activity, the removal slows activity as individuals hoard savings. So we get nothing by doing it, and we get destroyed by not doing it. That is a treadmill. I don't know how we get off. Meanwhile, the only real winners in this are the top 1%, maybe the top 10%. You can see that this orange here is the top 1% of the population. Look at how much their wealth has grown. Next, we have the 90 to 99% people. They've not done too badly. Then we have the 50 to 90%. Pretty pathetic, really, since 2003, less than 20% growth, when these guys have had 180%. And the bottom 1%, they don't even show up on the list. I'm sorry, the bottom 50%. So 50% of the economy has not benefited one bit from all the stimulus. The wealth gap continues to grow, and that wealth gap is going to cause problems going forward in the economy. And guys, I want to be clear. I'm not a doomsdayer. I'm not saying that the whole wheels fall off the economy. I'm just saying that it's going to be really hard to grow. We have this demographic phenomenon, thank goodness, with the baby boomers were the biggest generation in history, and then we each had 2.2 kids. So I did more than my part. I had 3. And so that's 3 times, or 2 times the size of the baby boomers are these millennials, and they're starting to come up into age. They're dominating the home buying. They've not even come close, not even a fraction of where they'll be in terms of their peak buying years. That really doesn't start until they hit like around 30. The baby boomers' peak buying years ended when we turned 46. So we have this gap between the baby boomers aging out and the millennials being babies. Now the millennials are coming up. So that's going to save the economy. But for now, I think it's going to be a little bit of a problem. Yes, sir.
Hey, Dan, I want to jump in. I know you got a lot more to go. And guys, we're going to net this out at the end, make sure you know what rates are doing. But I've had a couple of questions come in, and they range from people wanting to know, like, hey, what of all the things you're telling us, what's most important for us to communicate with real estate agents? Or what are some of the highlights from this presentation that they should be sharing on social media and educating, using social media? And I know you do a lot of that teaching and training in your mortgage mentorship program. I think, the daily updates, you're saying, hey, this is what happened in the market. This is what it means for rates at a high level. But could you just, for any folks that have to go before this thing ends, could you just tell everybody what mortgage mentorship is a little bit, just for anyone that's listening right now?
Sure. I've got a couple slides here, if you don't mind. Here we go. And by the way, I'll answer those specific questions at the end in terms of, what does this mean and what should I be sharing? So what we do is 2 live daily updates every day, and then a weekly video, which our members seem to really value. Basically, everything you're hearing today is in the Sunday night video, consolidated into about 20 minutes, including 5 to 10 stocks that grab my attention. Our win rate is pretty impressive. Last week, we were up 6.7% just for that week. Week before, I think we were up about 4%. And content. Every day I post content that is shareable, that should be used for realtors, for consumers, for whatever. And it's the knowledge that's really going to set you apart. So you'll learn how to determine the direction of rates by looking at a chart in less than 2 minutes. You'll learn how to predict when the big investors have started dumping bonds and selling assets. We saw this coming. We were able to predict this latest pullback. You'll anticipate the Fed's movement. You'll understand what they're going to do and why they're going to do it. And we've been pretty accurate about predicting the Fed. Another pat on the back, when that whole pandemic broke out and everybody was panicking and rates shot up and mortgage business came to a halt, I put a video out to the industry and I said, relax, here's what the Fed's going to do. That was on a Sunday night. On Monday, the Fed announced what I had done. Why? Because it was obvious. If you follow what I follow and you listen to what I can teach you, this stuff becomes obvious what the Fed's going to do. And through that, you can avoid economic catastrophes. And you'll learn to predict the direction of home prices. We've been pretty accurate about when we said that home prices had peaked almost to the day. And the stock picks are pretty good. I'm not going to run through all of these, but here's an example. And this is actually the alert that went out to our members. We said to buy it here, and then 3 or 4 days later, it went to there. This was a situation where we said to buy this on this day here, and then 4 or 5 days later, it did that. So we have a lot of Bitcoin fans. So we had a bunch of members that got all excited about Bitcoin when it pulled back. I said, no, no, it's not done yet. And I drew out a scenario of what I thought would happen, and we got that pretty right, including this recent breakout. So that's it. We'll help you predict the direction of interest rates, the macro direction of home prices. And by the way, all this costs $24 a month, which I hate using this because everybody does it. It's way less than it costs a Starbucks. Skip 1 Starbucks a week and you can pay for market mentorship.
Love that. And guys, the way I want you guys to think about it, there's knowing what's happening in the market well enough to talk to a consumer, well enough to, be educated yourself. But if you really want to teach and train and turn this into a competitive advantage, where you go beyond what the typical loan officer do, this is just a must. So for all you either want to be market nerds or market nerds, this is a no-brainer. I support it, endorse it. Go to marketmentorship.com, sign up. I mean, $25 a day. And hey, if you love Dan Rawitch and you just feel like the guy's giving you a lot of value, it's a great way for the mortgage coach community to support Dan and everything he does for us. So Dan, really appreciate you, brother. And I appreciate the video you do every day. So keep netting it out, and I'm sure we'll know what rates are, to the best of your ability, know what rates are going to be in a few weeks.
Well, yep. And let me throw in a quick plug too before Dan gets going. I mean, I've been a member of this and the options group now for a little over a year, and I just look forward to getting that video every Sunday night. I typically watch it Monday morning while I'm drinking my coffee. But it really does. I mean, one of the things that, regardless whether you're the most experienced loan officer or brand new, is the confidence, right? Confidence in the conversation. And what Dan's dripping out each week and each day are those little nuggets of insights that you can actually use to talk to your team and your clients and your referral partners to make you sound a lot smarter than, at least it makes me sound a lot smarter than I am. And then of course, I'm not as nerdy. I should be doing more of Dan's stock picks, but I'm not glued to my computer every day. But I do probably once a week, at least jumping on 1 or 2 of them, and that's been pretty epic as well. So I would strongly encourage you guys to jump in. It's inexpensive, and like Dave said, it's a great way for you to learn and support someone who's been just a huge influence on our community.
Thank you, Todd. I appreciate that. It means a lot coming from you. So here's why I don't worry too much. This is the concentric circle by the way, you see popping up here, I recommended a stock to our members yesterday, and it's moved very nicely today. So our members are like, do we sell now? And another member said, no, Dan said 91 is the target. So I just love those. I love seeing those wins. So here's what happens. The Fed pulls back QE. The market declines. This is, by the way, this is a circle that's gone round and round. This is not news. This is not some radical prediction. This is what happens. Market declines, consumer confidence falls, the economy gets weaker. The Fed says, oh, things are weak. I better start some more QE. Drives the market up, consumer confidence rises, economy stabilizes, and the Fed withdraws the QE. It's just this concentric circle. And so where are we right now? We are, well, we're here. We were here, but I think confidence is pulling back. And I don't think we're going to see this. So I don't think this is going to happen. But if this does happen, if I'm wrong, and this happens, then this will follow, and it will not be a very lasting problem. Another concern I have is look at the debt. Now, while you hear a lot about savings records being created during the pandemic, more money was saved than ever before. Well, oddly, more debt was created than ever before. Consumer debt went from 69,000 to 82,000. Guys, I'm going back to 1922 here. You can do inflation numbers, which you should, and it would change the way this graph looks, but this is still an incredibly huge number of debt for the average citizen to carry. And the reason is 50% of the population benefited not at all from all these Fed moves. They have to borrow so they can keep afloat. All right, let's talk about housing real quick. So number one, housing remains affordable. If I'm wrong, and if rates do back up a little bit, this is what you want to pay attention to. I sold my house in 2007, and I sold my house because of this number right here. I remember like it was yesterday, the talk I had with Sophia. I was like, I don't know if things get any crazier. It's ridiculous what's happening right now. It's not sustainable, and housing is no longer affordable. And so we were very fortunate. So look, we're a long way from there, guys. This is a really good, healthy place to be for affordability. This you need to be talking to consumers about. People talk about, well, what if there's another housing bubble? Da, da, da. I wouldn't even be talking about that until maybe you're down around, these numbers. And I don't think we're going to get there. And this is JP Morgan. This is not great, unbiased third party. Home buyers, interest rates are still historically low, though they are inching up. Housing prices spiked during the last 6 to 9 months, but we don't expect them to fall soon. And we believe they're more likely to keep rising. If you're looking to purchase, it may be better now than it will be in 12 months. So this is a great, all these slides you can have, by the way. So what I want to do real quick is I want to just go through a chart, and then I actually have to go on, Todd. I got to cut it a little earlier because I've got a class to teach. Let me pull this up. So this is the yield chart on the 10-year bond. And again, if you followed me at all, you've heard of Fibonacci, but for those of you that might be new to the call, Fibonacci was a mathematician and economist back in the 12th century. And he developed, he found something out that was crazy. And that was that there are certain numbers that continue to repeat themselves over and over and over. And I'm talking about these numbers show up in the distance between our eyes in relation to the distance from our eyes to our nose, the distance from our nose to our mouth, and the relation of the width of our mouth to the tip of our nose, to the chin, the space between our ears. All of these relate in Fibonacci numbers. The amount of thorns on a rose stem, the amount of petals on a rose, the branches on a tree, the leaves on a branch, over and over and over, and they run all through our DNA. These numbers are so eerie that they were called the golden sequence. And so when I talk about Fibonacci, that's what I'm talking about. The Fibonacci was not a trading term. These were numbers that were applied to trading because of the magic of it. And you almost have to see me to do this to fully comprehend it. So I'm going to close this down real quick. And what I want to know is, so the yield back when it got real ugly on March 31st was about almost 1.80. and then it fell all the way down. We had this double bottom, which by the way, should tell you there was a problem, to 1 point. Well, intraday, we got down to 1.13. We'll call the actual low close 1.70. So what I'd like to know is, as things bounce back up, what percentage move are we likely to see? And that's where Fibonacci comes in. So if I say, okay, we started here and then we came down to here, this represents 100% drop from here to here. This first line, 2, 3, 6, those are Fibonacci numbers. And in trading, that's 23.6%, meaning we know all the time, unequivocally, when we see a drop or a rise end, we're going to see a 23.6% correction, and we got it. And look at how perfectly it held that number, and it came right back down to the baseline. And then look at how perfectly it held after that. It held here, it held here. Today it didn't hold. And what I said yesterday is if we close above 1.31 on the 10-year yield, we're going to go to 1.39. I know that with full confidence. Why? Because Fibonacci figured it out 1,000 years ago. It's going to do that. That's what it does when you cross one level of Fibonacci. Now, there's one small catch, and that is we have the 50-day moving average. This purple line is the average of all these price movements over the last 50 days, and they become very powerful as support and resistance. And what I want you to look at is, look at how perfectly it held, it held, it held, it rose, it tested it, it rose, it tested it, it rose, it rose, it rose, it rose. It didn't quite test it, but it almost did. It came down here, it tested it and bounced, came down here, tested it. Is that magic? I mean, to me it is. And then it puked and we gave it up. And that's good because this is yield. And it's managed to stay under that level since June. Now we're going to go up and test it again. And you don't want to cross this line, because when you cross this line, it usually means an intermediate move is in play. And it sometimes can mean a much bigger move. It doesn't have to. There are periods of time like here, we came down below it at a yield of 0.76. We dropped down to 0.53. That was a 20 basis point move. And then we got back above it again. So sometimes it doesn't stay down, but you can see, generally speaking, look where we gave it up here in January 9th, just before the pandemic broke out, and look at how hard it fell. So now we're at risk of rising back above that line. But I do believe even if we rise above that line, we'll probably hold this Fibonacci level. If we don't hold that level, then 145 is the next yield in store. And so again, if we're talking about the potential here in the short run of 5 basis points, that's about what we're talking about in interest rates, about 5 basis points. I don't like this chart. These are time cycles. Every one of these colory spaghetti lines represent a different time period. So we're averaging all these different cycles, and these cycles become very predictable. They move in fairly predictable patterns. And this gray line, you notice how this purple line does this and does this? Well, from the top of this point to the top of this point is going to match the top of this point to the top of this point. Same with the green, same with the orange. Look how perfectly, almost, I don't know, to me, it's amazing. This gray line is the average of all these time periods. So on average, all of these things are pointing up, which means higher here. This oscillator, I knew it was going to turn around at this point based on this indicator right here. This was the bottom. Off we go. So right now it's not a great picture, but I'm pretty bullish long term. Short term, I'm nervous until Thursday. Tomorrow we'll get the CPI numbers. If those come in hot, this is gonna get bad. If CPI comes in nice and cool, we'll probably just get a nice bounce off of 38 and come back down. 38 is a great retracement. It's healthy. It's the most common one. It's the one that traders expect. If I'm going to buy bonds, I'm going to buy them at the 38 level. Okay. That's all I got, Todd.
I just want to be respectful of your time because I'm so grateful for you, giving the community the insight to what you share with those of us who subscribe. And so bottom line is you're saying watch CPI. That'll tell you a short-term direction of rates. What do you see over the next 30 days, or is it just really tied to what happens with the Fed taper? What are you telling people both short and long term right now for rates?
Yeah. So if you could take the CPI equation out, which I realize is very difficult. So in other words, there's two things that move markets. There's the fundamental, which is the news, and then there's the technicals, which is the chart. So from a pure technical standpoint, what this chart is telling me is we probably hit this 38.2 level, and we probably back off from there. If we cross that level, then we're talking about 1.459. I don't think it gets any higher than this level here. That's just pure technical. Now you throw CPI in there, and CPI to me will just be a turbo booster. So if I'm right about this level being kind of worst case, then CPI will just, if CPI numbers come in too high, we're just going to get there much faster. If CPI comes in real cool, we won't get there. We'll stop at this 38.2 level. And then whatever CPI does, the effects of that wear off within 7 to 10 days, and then it becomes about the Fed. So all I can really talk about, because I'm just guessing about the news, is what the chart's telling me. And the chart's telling me that somewhere around 1.40 to 1.45 is where things top, and then they pull back to where they were.
And then it seems like long-term, really so much is going to be tied to inflation, which you predict is going to be kind of more tame than what people are expecting. And then ultimately what the Fed does with regards to taper. What else should people be listening to with regards to the news in order to know what rates are going to be looking like next year?
So obviously CPI is a big one, and the cousin to CPI is called PCE, which we got last week. PC stands for productivity, consumption, expenditures. And those are the things that we buy. Those are all the stuff that we consume. So when the PC numbers go up, then that's inflationary. And then on a manufacturing side, there's something called ISM, which is the manufacturing index. And I found that to be very much a leading indicator in terms of what's to come. And ISM has been slipping. I was going to see if I have So here's an economic calendar. So CPI is coming out. You can see what that looks like. It's not, it hasn't been pretty, but you can also see where it's been since forever. And you have to ask yourself, what's changed since this period? Nothing. The pandemic happened. Now the pandemic has to be gotten through. And then I believe we are back where we started. So what I do every week, Todd, and this is just briefing.com. This is free. There's a lot of places you can get news, but I'm always looking for what's coming out this week and what I need to be prepared for. So next week, retail sales is a very big number. If the consumers aren't spending, then that tells you that things are probably going to be slowing down. Housing starts is always a big deal because housing usually leads the economy in or out of a recession. I think those numbers are going to be okay, not enough to drive rates up. And then the following week, PCE, here you go. These are real big numbers. So end of August will be the next real big thing to watch out for.
Love it. Love it. All right. So a couple of people are asking questions. How do you define short-term versus long-term?
So for me, short-term is like 1 day to 7 days, call it 7 to 10. And then midterm for me is like, 10 to 45. And then long-term is out beyond 45 days.
All right. So someone's got a specific lock question too. Technically speaking, if we have buyers waiting to lock, the feeling is that they are going to worsen a bit, but that they should rebound. I mean, that was kind of your CPI thing that you went through.
Yeah. That's well said. Unless, I always have to have a caveat, CPI comes in and just slaps us in the head, like inflation. Oh my God, this is way worse than I thought. Then you could see a knee-jerk reaction in the market.
And I think that's where you guys as loan officers have to be the expert, right? And your goal is to hedge your clients from risk, right? And oftentimes they want, their cake and eat it too. And your job is to help them understand, maybe it's gonna be okay and rates will come back. But what if they don't? And then, I always recommend to loan officers be on the safe side, be the hero versus the zero if rates go up. All right. So marketmentorship.com. I mean, I can't say enough. A lot of what you're hearing from Dan might seem overly technical to you. However, once you've actually watched Dan's stuff for, a few weeks, you'll get a better grasp of all this and you'll be able to better reiterate it to your people who are important to you. I think that that's really the key. I mean, Dave talked about at the beginning, right? He put a link to his article down below. Take a look at that article. It is great. I think even if you're an experienced loan officer, but Dave said at the onset that it's amazing to see how many loan officers are taking off even after a year and doing over 100 loans. And to me, that's a little bit of a gut check, right? If you're not there yet, and you've been doing this for years, what is kind of the secret sauce? What is missing? And probably it's a little more confidence, a little more market knowledge. So I would absolutely encourage you guys to subscribe and then just spend some time. Like I said, I don't sit here glued to Dan's recommendations every day. Apparently, maybe I should be. I'd be a lot wealthier. However, it's just a great opportunity. You'll catch trades in there. I was looking at it while we were sitting here. Dan's trade that I jumped in yesterday is up for me. When I jumped in, 29.7%. So not bad for a one-day return. And I've learned how to set stops and all these things in there. So that way, if the market turns, I'll still keep my gain, but it'll still allow me to keep going. And when the market's running. So I actually sound pretty smart, huh, Dan?
Yeah, you do. I'm so happy. And you were the lowest maintenance member I have. Like, I didn't even know you're still a member. I'd never hear from you. So,
well, it's funny. I'm just a quiet observer. Someday I'll peek in and people are like, oh, hey, look at Todd's in this group. But I sit there and I watch all the conversation and I learned from Spencer and everyone else with what they're doing in there. And I'm just grateful for the knowledge. And, for me, it's one of those things where, if I've got time during the day, I'll peek in there. But me, I'm all about productivity and trying to encourage you guys to grow your business. And I think just investing a little bit of time. I mean, the fact that Dan does these short videos in the morning at the end of the day that you can watch on your own time, I think that's really where the secret sauce is. And then my secret for Dan's weekly thing, he sends it out. I download it to my computer. I put it into QuickTime or whatever the Apple defaults to, and I watch it at 1.5 to 2 times the speed. And then I just pause it and read the slides when I need to. So instead of me taking 20 minutes, I actually do it in about 10 minutes.
I love it.
But for me, it works.
Yeah, I love that. That's a great idea. I don't want to listen to myself at regular speed either.
All day. I mean, that's really it. And Dan does all these in the options group. He does all these live videos. I've never, ever been on one of his live videos, but you never know. One of these days, I might jump in there. So anything we forgot, Dan, any last minute words that we should kind of give this group, since I know you've got to jump?
No, just, tap it, reach out to me, guys, Dan at universityofoptions.com. And I try to answer everything. I'm not perfect, but I do my best. And I'm always happy to help you guys. Dan at universityofoptions.com.
All right. Well, I'm just super grateful. I love spending time with you. I love hearing what you have to say. I know that I speak for the whole mortgage coach community. We're grateful for all the free stuff you do. I think the fact is you guys might need a little bit more, and this little cost that Dan charges, marketmentorship.com, I would totally suggest that you look at it. And if you're around in an hour, we're going to do the TCA a day accountability. Jeremy Forcier is going to be leading that. It's going to be great. There's a big text chain going on my phone that I haven't read between him and Deborah Bird about all the excitement she wants to bring to it. I know it's going to be awesome. Super grateful for all of you in our community being here. So on behalf of Dave and the team at Mortgage Coach, myself and the Win by Noon team, Dan, thank you. Thanks everyone.
Thanks, Todd.
Look forward to seeing you guys on the next call.
All right. Bye, everybody.